welcome to Business Television India. You're watching Beyond the Bottom Line and I am Hiral Desai. With the kind of change in sentiment that we are seeing with the mid-cap IT space, let's quickly connect with Nitin Rakesh, who's the CEO and Executive Director at MphasiS. Welcome to the show, Nitin. To start off with, firstly, you've joined the company, it's almost been a year now. How has growth been in the last 1 year versus the last decade in terms of where MphasiS was concerned?
Sure. Thanks for having me. I think it's been pretty much a breakout year for us in terms of growth, positioning, repositioning, and more importantly, I think we are after about 8 years being inside of the HP family, and prior to that 2 years within the EDS family. For the first time, again, we are an independent business and we can reestablish our brand and our position as such. I think in terms of the performance, I'm pretty pleased by the fact that we took FY18 essentially as an opportunity as well as a challenge to break out of a slightly anemic past decade. We had a very good first couple of years under the HP umbrella, and then last 5 or 6 years were a little bit challenging.
Right.
So we've really used this opportunity to break out, and we've had almost industry-leading growth in the last 3 quarters.
Right. So overall, since you've joined, what are the changes that you have embarked in terms of business?
Sure. I think first and foremost, we had to kind of set ourselves a certain objective, and we defined our top 4 priorities as what we now call the 4 Gs of growth. Again, the priorities are growth, 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 and growth. Growth that is consistent, growth that is competitive, profitable, and responsible. And essentially, it's a flywheel effect that we've created. What that really means is that we want to be able to create a long-term sustainable business that essentially continues to add value to our clients, continues to bring opportunities to us in a consistent, long-term, sustainable manner, gives us the ability to reinvest back in the business, and that's why the business has to be profitable. And finally, we want all our stakeholders, employees, customers, shareholders, as well as our society to benefit from it. So that's kind of the flywheel effect that we started to create.
Right.
And we've also kind of tried to reposition ourselves, essentially taking off from more of a next-gen services player. Almost half of our revenues today are next-gen revenues.
Right.
And that's been the turbo engine of growth for us this year as well. So I think it's really, we are a transformation story right now, very much undergoing, I would say, the first phase of a 3-4 year transformation. And it's great that we are actually getting support from our clients, our shareholders, and obviously our employees as well.
Right. So what have been the key challenges that you have been facing so far to embark these changes? Because yes, as a company, they have been, inclined to function in a certain way.
Sure.
Now with the kind of changes that you're embarking, are there any challenges that you're facing as a company?
I think firstly we had to, as I said, set a vision and a direction. And I think we did that with the reset in the shareholder, with the reset in the management. So those were 2 seminal changes that happened in the company later part of FY17. We also we were a tale of 2 stories pretty much in terms of 5 years preceding the transaction. We had one part of our business that was growing well, which was the direct business, but we had also another part of the business, which was the HP business, that was declining. Net effect was the company wasn't really on a growth path. Once we put a stop under the HP business with the contractual commitment, we were able to then use that to springboard and turn around that business as well. I think so. The way we are looking at it right now is we have 4 engines of growth. Firstly, we continue to do what we did well, which is focus on our strategic accounts.
Right.
We've added to that the Blackstone channel opportunity. So we are right now very convinced that that's a long-term opportunity. We've seen early success. We are starting to focus on doubling down on that from an investment perspective, and I'm pretty confident that it's as I said, a 3 to 5 year opportunity we'll continue to gain from. Thirdly, we've also added new engines of growth in terms of areas like Europe. Our position in Europe is fairly, as I said, underpenetrated. We have a long-term opportunity there as well, given 1, small base. 2, we have a core kernel of referenceable clients. And 3, I think we have a strategic approach in the overall business that will resonate well in the Europe market as well.
Right.
And finally, I think we've also turned around the HP and DXC opportunity channel into a growth engine this year. So I think that's kind of, we've kind of gone by it, piece by piece, identified areas of growth and opportunity, fed them through investment, and back them up with capability, competence, and the ability to actually deliver.
With all this said and done, how would you evaluate the growth that you've seen between FY15 and 17 versus what we've seen in terms of
Sure.
FY18 overall? And how significant do you think is it for your company?
I think FY18, as I said, is a breakout year. It's a year where we established our reposition back in the market as a growing, diversified next-gen services company. So FY15 to 17, as I said, was a tale of two cities. We had
Correct.
below industry growth, and largely in part because of the leakage of business we saw from our parent company. As I said, focusing on those four engines of growth, we've been able to turn it around. I think we've seen pretty good pickup in all of these four channels. We obviously have the proof of the pudding is in the clients voting with their dollars. In the first 3 quarters of YTD till December, we've actually seen 58% jump in our TCV deal wins, which means we've sold 60% more business,
Correct, than last year.
net new business than last year. So I think that's what's reflecting into our revenue growth. That's what's giving us the confidence that we can sustain this growth. And that's what's also helping us invest back in the business in next-gen services and technologies of cloud and cognitive.
Right. So if you talk about the clients that you're dealing with, from IT space as a whole, not only talking about MphasiS, how have demands changed? How have trends changed as to what the client is asking now versus what they used to ask earlier?
We are a reflection of our enterprise clients' business, right? In the end, we service Fortune 1000, maybe Fortune 2000 names. And more often than not, these are established companies that have been doing business for many, many years. And in the past, technology used to be a back office function run by the CIO, primarily an enabler to the business. 80% of technology was seen as an enabler, maybe 85%, and 15% of it was seen as a differentiator. And what's really happened over the last 4 or 5 years with proliferation of digital tech, especially driven by the smartphone, and the fact that the whole world is now an app. And that's how your consumers want to interact with you. What's really happened is what we call every business is now a digital business. Only difference is some don't know it yet. But I think the capabilities and competencies the clients expect from you when they see themselves as a digital business, or when they're under onslaught from technology companies, those capabilities are different. They're not just about leading with cost optimization. They're not about your mess for less. They're more about, can you help me stay relevant to my consumer? Can you help me improve the customer service that I am able to show, give, the customer experience that I'm able to show? Can you help me understand my customer better? And it's not just about KYC in the regulatory terms. It's really about knowing your customer to a point that you can actually customize the product and service, right? Think Netflix, think Uber. They know you as an individual consumer. They don't do mass mailers to you, right?
Correct.
Similarly, can I actually then expand my wallet share with my consumer? And I think Amazon is a great example of how they've taken their customer understanding and they've kept launching products after products, cross-selling to the same customer. Can you do it in a way that my time frame to reacting to consumer is not days or hours, it's actually seconds and minutes? So basically, can you use technology to lower my response times? And finally, while I do all of this, can I still have a lower cost?
Correct.
So that's kind of the paradigm shift from being cost-led to being, can I help them meet business objectives? Can I help them survive?
Product focused now?
Actually, not really product focused. It's more of an alignment to what the business needs.
Right. So that's in terms of digital, very well explained as to, how our client demands shifting. With that, yes, the IT industry needs to undergo a sea change.
Sure.
Do you think, in the last couple of years, we have been able to do that? And do you think that the companies are transiting into a different business model altogether?
We basically have doubled down on 2 core offerings for the market. Firstly, we help our clients undertake a customer-centric digital transformation, what I just explained to you. How do you deploy technology in front of the consumer? How do you increase the experience? How do you use data to personalize? How do you use data, obviously in a good way, to understand the customer better? How do you increase his response times? And more importantly, can we do this in a digital time frame with applying technology and automation to lower your cost? So I think we've done that. So that's kind of one big motion for us, which is consumer-facing digital transformation. And the other big motion is we've been also very aggressively going to our clients and saying, there is an opportunity for you to apply all things automation, new technologies, and reduce your core footprint, so you don't have the problem of spending too much money in just maintaining your systems, and you free up your resources in investing and investing behind new technology. So I think those are the 2 core things we've been doing. Again, proof of the pudding is in the fact that we are starting to see that flow into our growth. The fact that we are now set for and high single to low double-digit growth for FY18, which ends in a few days, is really what's giving us a lot of confidence that we should be able to be a leader in the pack when it comes to applying transformation to our own business.
Right. Talking about HP as well, as you mentioned, we have started to see a turnaround, and that's pretty much inevitable. What's the growth plan with HP going ahead?
So I think good news is that it's no longer just one monolithic relationship, right? We've seen HP itself go through a corporate restructuring, and now there are 4 distinct legal entities, and we have 4 distinct relationships. So the way we kind of talk about that internally in a joking way is, we bargained for 1, but we got 4. So kind of you buy 1, you get 3 free. So it's an opportunity for us to use our relationship with those 4 strategic, large Fortune 500 companies and essentially reposition our value proposition in a way that we are able to give them value, and hence we should actually be able to find growth, and that's exactly what we've been doing this year.
Right. So what's the growth expectation over the next 3 to 5 years?
Sure.
Talking individually about HP, not as one entity, but as 4 entities then.
Yeah, again, we haven't broken out the 4 entities publicly, but what we really said is if this has to be an engine of growth, then we have to find ways for this to grow at or above market. FY18, we set the target for this to grow at market. It turned out to be one of our fastest growing businesses, and again, I'll take it any day, and obviously we're very happy with the turnaround. If we can sustain this kind of growth, then clearly our aspiration will be to continue to grow this business at or above market, at least in the foreseeable future.
Right. So overall, if I have to see your total revenues, around 24% comes from HP right now. The remaining is, I think, around from direct international businesses.
Sure.
Do you think the direct international business is also expected to grow the same way that you're expecting HP to grow then?
Yeah, I think there are 2 or 3 businesses within direct international. Direct core, which is kind of the core business where we sell directly to international customers, has grown almost 2x the market growth last 3 years. We expect that to continue to grow above market for sure. Digital risk has been a little challenge business because of macro situations in the US. It's linked to interest rate cycle. We've kept that stable this year. We probably have to continue to find ways to keep that business stable.
Right.
And we'll probably give more color on the guidance as we get towards the beginning of next financial year. So, and I think the trick really is, right now we're in a happy position where we have 2 well-growing businesses that are competing with each other for growth. And if we can keep both of them at or above market, then I think at an overall company level, we can continue to aspire to grow above market.
So do you think that the mix is expected to remain at the same levels, or in the next 3 to 5 years, with the way we've seen a turnaround with HP, it could change wherein HP could start taking a larger pie of the revenues?
So I think at one point we used to be 75 to 80% HP. I don't expect us to go there. Beyond that, I don't think we should worry too much about what is the percentage of HP, because again, as I said, it's not just one entity; it's 4 distinct entities, and I wouldn't worry too much about whether it's 25% or 30%, as long as we can see growth across the board. I think every account is a growth account, every relationship is a growth relationship. So with that mindset, if we continue to grow everything, then I think we should see a healthy mix of growth coming from all our growth engines.
Right. Talking about digital as well, everyone, we also spoke about it right now, that's the next leg of growth going forward. How big do you think will digital contribute to your revenues in the next 3 to 5 years?
So the way I look at it, it used to be about 1/3 of our business, FY17. It's almost half our business today, right? And the way we are repositioning our services, I see no reason why everything we do shouldn't be seen as applying next-gen technology to an existing process or to a new opportunity. So, I mean, theoretically, there's nothing that shouldn't be in next-gen services as we define it in the next 3 to 5 years, right? So we are probably at a point where we are going to cross the chasm to more than 50% digital, and that should in itself show the fact that we are actually already crossed that.
So, staying with digital itself, majority of the IT companies are showing growth in terms of the digital segment.
Sure.
Is it coming from the reclassification of the old projects, or is it new projects that companies are undertaking in digital?
Again, I can only speak for ourselves, and I think for us, as I said, it's really a combination of either deploying consumer-facing tech or data and analytics, or applying transformation using AI and automation to an old process. If it's not one of these two, we don't call it next-gen services.
Right.
As far as the industry is concerned, I think, of course, there is opportunity to classify all things data as digital because there isn't a consistent definition.
Right.
I think each company has adopted a certain framework, but I think broadly, there is a certain congruence in the way these things are defined. And yes, it's a high growth area, but I think I'd be remiss if I didn't say that we are probably the farthest along in conversion of our overall book.
Right.
We are almost getting to 50%, where I think, as I said, is crossing the chasm is more important.
The next leg of growth again is going to be artificial intelligence. How big do you think is the space of artificial intelligence, number one? And do you think there is a chance it could take over and probably reduce the employee cost for IT companies in turn then?
So I think let's demystify AI as a buzzword. It's not really something very new.
Correct.
There is AI embedded in almost everything we do even today,
Correct.
right? Whether it's interacting with our cell phone or talking to Alexa, all of that is really some form of AI embedded in it. So instead of focusing on AI as a revenue line or as a service offering, what we've really done is we've taken cloud and cognitive as the two pillars of everything we do.
Okay.
Everything we do in terms of building new application is native cloud and embedded AI.
Okay.
Right? And if you take that approach, everything we touch will be powered by some form of intelligence, whether it's machine learning or true AI or cognitive or pattern recognition. So from that perspective, I think I don't differentiate AI as a separate service line. I think it's actually it's going to become a foundational element of all things technology in the very near future.
Right. And what's your thought in terms of where blockchain goes? Do you think that's something also that you as a company are looking to integrate?
So we have a blockchain COE. We've got active pilots and we've got relationships with clients where we are deploying the tech in multiple different areas. I think the blockchain is in what I call its early stages of the S-curve, where it's been talked about a lot, but no one's really got a very live, solid use case beyond e-governance. There are news of the Middle East adopting blockchain for land registry, for example, and so on. So I think true commercial use cases are still, I would say, a little far away. But there is very high degree of interest because it's essentially a digital ledger technology.
But do you think it could be as big probably as something, because right now the only words that everyone very generically understands is digital, artificial intelligence, cloud.
So I would say blockchain is a very specific instance of applying digital technology to a ledger system, because it's an open ledger. Right? And will it become the foundation of all things trust and banking? Potentially. Right. I don't think it's going to happen in the short run. But there is high degree of potential that you can apply it to anywhere where you need trust or record, some form of record keeping, where you can apply technology to actually automate it. What this means to the banking business, to the insurance record business, to the land record business,
probably the pharmaceutical business,
medical records, background checks. So there are multiple different use cases that are being experimented with right now. It is a very heavy usage of compute power technology. I don't think it is mass applicable today. As the processing power and computing power keeps increasing, especially if you deploy it on the cloud, this will probably become more mass adoptable, I would say at some point in the medium term.
Beyond that as well, if you see in terms of geographies, Europe is something that you're still opening up to. In the next 3 to 4 years, probably, then again it becomes long term, but in the next 2 to 3 years, then what percentage of your revenues do you think could come from Europe?
So I think we have about 10% of our book right now that is Europe-centric, mostly UK and a little bit of France and Benelux and DACH. What we basically said is, given the fact that we have a set of marquee customers, we have referenceability, we have capabilities in the region. We've been in France for 20 years, for example, through an acquisition. We should really be able to grow Europe faster than the company growth rate. And if that happens, we would like to see the contribution of revenue from Europe to go up from 10% to maybe 15 or 20% over the next 2 to 3 years. But keep in mind, US is growing as well.
Exactly.
Right? So I think again, as I said, we are in a happy position that we have a.
Because I think US also from a 74%, we've seen it move up to almost 78, 79%.
It's almost 80%, now. And that's at the cost of what I call other countries. And again, we believe in focus. We believe in not spreading ourselves too thin. So from that perspective, these are our two core markets.
Apart from that, in terms of vertical service as well, BFSI growing really well for you. Insurance is doing pretty well. IT, communication, entertainment, and emerging industries is something which is going down slowly, steadily as a pie to their total revenues. Do you expect that trend to continue? Or will we see a shift again happening in those segments as well?
So while we report banking and insurance, and then we report ICE and emerging, I think the way we actually run the business is we focus on micro verticals.
Okay.
So the way we look at it is that banking and capital markets is actually made up of 6 or 7 sub micro verticals, right? From consumer banking to mortgage to payments to wealth management to brokerage to asset management. I think we have a long way to go where we can say that we are mature in all of these micro verticals or sub verticals. Similarly, in insurance, there is PNC insurance, there's life and retirements, there's commercial, there is sub-segment of PNC. So the approach we are taking really is at that micro vertical level. Having said that, we've also got sub verticals within emerging, for example, logistics and travel that has actually done really well for us. We've got initial signs of healthcare starting to do really well for us. So I think it's really going to be a combination of what we call Horizon 1, Horizon 2, Horizon 3. We'll have some verticals that are core to us, so we have to keep them growing. We've seeded some micro verticals that I think we're starting to see good growth in. Example, within insurance, we're starting to see good growth in life and retirements. And then we'll seed some extremely new ones that we haven't had historically. Healthcare is a good example of that, and I think we'll be able to kind of make it meaningful to us over the next 2 to 3 years.
If you see in terms of deal wins as well, last year we saw around 80 to 100 million. Again, now it's moved beyond 100 million. Do you think this trend is something which could continue?
Well, we would like it to. And the reason is very simple, right? We had primarily just one engine of growth till last year, which was our strategic accounts and our existing portfolio. We've now added at least 2 more to the direct international bucket, Blackstone portfolio as well as Europe and new accounts. So I think we expect this to continue to show some good progress.
Right. Overall, in terms of IT, again, the next important thing that impacts a company's earnings is the rupee dollar move or any cross-currency move. What's the kind of hedging strategy that MphasiS actually follows?
So, we actually declare our overall outstanding hedges, and we have a 4-quarter rolling 80 to 100% hedge policy, and then beyond that, for 2 quarters, we take up to 60% hedge. So, we probably are one of the few companies that gives out the overall outstanding hedge number as well. And again, the reason is very simple. We are not using hedging to make short-term gains. We use hedge to protect our business plan. If we can have visibility into the next 4 quarters, we'll then work backwards from there to decide how best to run our business within the parameters of that visibility.
In terms of margins as well, we've seen them consistently now start to rise. What's the number do you think is an aspirational number in the next 3 to 5 years, where you think for a company like yours, this is something which should be achievable and sustainable?
So I think there's no magic number per se. As I said, right, if more and more of our business continues to go into next-gen services, where we do have the ability to not be under pricing pressure, have some power over how we are able to price those services, then I think that's a structural tailwind to the business. Counter to that, obviously, is the fact that when you get into these services, it's also a higher cost base of people, and you need to invest back in the business as well. Structurally, the way we've decided to kind of focus on in terms of our long-term aspiration, long-term meaning the next 3 to 5 years, if we can continue to grow faster than industry, we will have the ability to continue to increase our operating margin profile. And that's kind of the aspiration that we are working with.
Right. With all of this, FY19 also, the constant currency guidance that NASSCOM has given is in the range of 7 to 9%. For MphasiS, do you think overall, will you be able to outpace that? And number 2 as well, if you take FY18 as a year, the first 6 months have been slightly muted for the industry, but in the last 6 months, the kind of up move that we've seen for IT companies is immense. And it's not only, it's not, I'm not talking about the large cap guys. It's more of the mid cap counters who've seen a boom come in there. Do you think that in terms of deal wins as well, what did not come to in the first 2 to 3 quarters has flown in for IT as an industry in the last quarter?
I think it's fair to say that there is one part of the business that is growing really well, which is application of all things next gen, or what we call digital. If you're already a major player there in terms of your own mix of services, then your growth will be much better and your deal wins will be much better. And I think this deal wins number will probably have to undergo the way we report it in terms of the fact that not all digital deals will follow the same trajectory of traditional deals. But if you're playing in core services, ADM, IMS, BPO, then the ability to actually show growth will be muted because no client is funding that any more than they did last year. So I think that this is a time where you will see a fairly strong divergence based on the portfolio of the company, at least for the next 3, 4, 5 quarters, because it will be a direct reflection of where they're playing and how they're actually able to capture the growth. So I think one size fits all is not the right number.
Okay.
7 to 9% is probably an average across all spectrum.
All spectrums.
You will definitely have companies that will beat it, and you'll definitely have companies that will lag it.
And what about emphasis
Well,
on
of course,
that?
we want to be able to beat it, and I think given the tailwind and our momentum, that's going to be our aspiration.